As a forex trader, imagine having a best eye view of the market where you can see a big picture and make informed decisions. That's exactly what we are going to do today. As we take the top down approach to analyze the financial market or the financial data from the macroeconomic trends to a micro level, we will cover it all. So let's dive in to see what we can cover. By the way, if you are new to this channel, I'm Akamlo Forex. And don't forget to click on the like button and also click on the subscribe button to subscribe to this channel to be one of the first people to have my videos whenever I upload. And stay connected to the end of this video. I'm going to make it very easy and simple for you to understand the top-down analysis approach. I want to make you the best or the professional trader that you always want to be by watching this video to the end. And don't forget to leave your comment in the comments section. Let me see your thoughts concerning this video or what you want me to do for you next. So in the top-down analysis, we have three time frames that we look at. The first we look is going to be our higher time frame, and then from the high time frame we have our mid or our medium time frame. From the medium time frame we have our lower time frame to look at. We have our lower time frame, and this lower time frame, all these time frames also has its options or what we are going to do in these time frames. The first time frame, which is our high time frame, is we are going to look at the directional bias of the market. So we look forward for directional bias. We look for bias in the high time frame. In the mid time frame, we look for our point of interests where we are expecting price to get to before we take a trade. And then the lower time frame, we look for entry. So these are the three things that we're going to look at. And as a day trader, these time frames are very important, and most traders or some traders can use a daily time frame as the high time frame, a daily as the high time frame, or the 4H as their high time frame, and use the 1 hour as the mid time frame, the 1H as the mid time frame, and the 15 minute as the lower time frame. So using the 15 minute as the lower time frame. So but in this particular video, we are going to use only 4 hour as our high time frame, the 1 hour as our mid time frame, and the 15 minutes as our entering time frame. So let's dive into the chart to see what how we can literally apply this in the chart. Okay, so now in this is a gold. This chart is gold, so you can literally apply this concept in any financial instrument. So we go in for our 4H time frame first, and that is our high time frame. We are going to look for our directional bias. So in this case, if you open your chart, you look for the right hand side and also the left hand side of the market. We are looking for the right hand side of the chart of the trend because we want to see where one where the liquidity is. First, we want to see where the liquidity is, and then the second, we want to see to identify our institutional reference points. Institutional reference points. Our institutional reference points. And these institutional reference points are the breaker blocks, the order blocks, the mitigation blocks, the fair value gaps, and our order flows and the rest. We have about 7 institutional reference points. So first, we look to identify where a liquidity is. This particular level is a level of liquidity where we'll be expecting price to get into. The second, we have this liquidity level here too as well. Liquidity level 2 here as well. We have this liquidity level here too as well. Right? We have this liquidity level. So it take step by step. Price take this liquidity, we look for the next liquidity for price to get to, and we look for next liquidity to price gets to. Right? And in this case, we also have this particular fair value gap, which is our institutional reference point. So, which is our institutional reference point at this level. And in this fair value gap, this is where we are expecting price to trade into after grabbing this liquidity level here. If price take this liquidity, we look to see price to get into the fair value gap, which is our institutional reference point, to give us a continuation to an upside. So this is what we are looking at. So in this case, you can see our level here is where we are expecting price to get into, and our directional bias concerning this is going to be bearish. We are looking for price to move bearish to this level. We move to the 1H time frame, which is our mid time frame. And in this time frame, we look forward to see where we should be expecting to take positions, to take the short position to where we are expecting price to get into in our high time frame. So as you can see here in the right hand side of the chart, we have a structure shift at this level. We have a structure shift here. After price giving us the structure shift, we can see a displacement below. After this retracement, we have a displacement to give a break of structure. So we have a clear break of structure with the displacement candle here. So here, so when price give this break of structure, you can see price is now retracing. So when price is retracing, we are looking for another institutional level where this retracement should end. So price retracing back, we look for another institutional reference point where this retracement should end, and to give us a confirmation to continue down or to continue bearish. So in our first institutional reference point here, we have our fair value gap, which is this particular one here. You have this fair value gap. We have this fair value gap where price is currently at, is rather. And after this fair value gap, we have another institutional reference point which is this breaker block. We have this breaker block at this level, and then we also have an order block at this level too as well. And so you can literally see that we have about three institutional reference points at this level. And these are the level that we are expecting to see price to get into. So if price gets into any of these institutional level, so for now, let's pick one to do our examples, right? So let's use the order block. So let me take off this and then this one too as well. So we're using this order block as our institutional reference point. Now this zone here is our point of interest or our zone of entrance. So it's going to be our point of interest. So this is now our point of interest here, where we are expecting price to trade into. So if price trade into this level, we now move to the 15 minutes time frame, and that will be our entering time frame. And to take decisions at this level, we wait to see price trade into our point of interest. Then we look to see a market structure shift at this level. So if you have a market structure shift here, we have a market structure shift, then the next one we are going to see, if you get a market structure shift at this level, is a signal for price to reverse lower, to go in bearish. So you now look for your institutional reference point in the lower time frame to as well. That's your entering time frame here. Maybe using a breaker block at this level to wait price to trade back into that level, and you can now take your sell trade. So this is how you have to take the trade. You look for your directional bias, come to find your point of interests, and now come to your entrance. Your entering level is so known as your confirmation time frames, where you expect price to get into. If you are finding this video helpful so far, make sure you hit on the like button and leave your comment in the comment section. And this is how you take your trade. I'm Akamle Forex, logging out. See you in my next video.